From New York City for our viewers worldwide, I'm Dani Burger in for Jonathan Ferro. Big tech AI finally feels the effects of gravity. Bonds little change as we await the all-important CPI data and a very busy week. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, markets on edge. It's another key U.S. inflation report. Traders brace for a policy pivot from the Bank of Japan. And the crypto rally marches on. Bitcoin tops $72,000. But we begin with a big issue, counting down to U.S. CPI.
We're projecting 0.33% month-on-month core CPI inflation, and that's following 0.39% month-on-month core CPI inflation. And those are somewhat uncomfortable readings if what you're telling the American public is that we're coming back to 2% inflation, because it's just not. I don't know that there's a right or a wrong answer for the Fed here. I do think that they're seeing enough in those inflation readings that will get them to a cut in June.
Do we need to get ready for another uncomfortable number? Joining us now is JPMorgan's Kelsey Berro and Jason Draho of UBS. Kelsey, it's been a difficult bond market to trade in. We've been whipsawed around by the data. We have the scars of last month's CPI that was too hot, that sent markets spiraling. So how do you prepare for a week like this?
So to start, I think you do need to be fairly humble here. We know that in any given month, the data can be fairly noisy, and January told us that, just that. But I would stay focused on your conviction about the trend. And for us, we do feel that the trend for inflation is still one of moderation and one of disinflation over time. And I think that the jobs report on Friday really emphasized this, particularly the wage data. So there's been a lot of cross currents, a lot of signals that look like they're pointing in different directions. But the one area where things have been fairly all pointing in the same direction, telling a clear story, is on the wage front. Wages are moderating. It's easier to fill jobs. If you're looking for a job, you can find one, but it's a little bit harder than it used to be. And all of this should be giving the Fed comfort that we're not in a reacceleration. We're in still what I would probably call a soft landing.
Jason, can you feel conviction about the trend heading into a week where we get CPI, bond auctions, retail sales, and a UMich survey?
Well, I can have reasonably high conviction, but not really strong conviction. I would agree with Kelsey's point that if we look at the trend, whether it's inflation, but in particular the labor market cooling over the past, not just 3 months, 6 months, but over almost 18 months, the trend towards a moderation in the labor market in terms of job openings, wage growth by a variety of measures, they're all trending in the right direction. And we saw on Friday with the average hourly earnings, it would suggest that the high number in January was that seasonal effect. I think for the Fed, that's the key thing of the inflation data. They don't care about the month-to-month noise. They think, where is inflation going to be at the end of this year, but also at the end of their forecast horizon of 2025. And if you look at the labor market data, it has to give you some comfort that it is trending in the right direction. Now, whether it's enough for the Fed to want to cut in May or June, that time will tell. We'll need to get more data. But I think as the overall trend, I think we have pretty high conviction that this is going in the right direction.
It's going in the right direction, and the bond market has been moving off the back of it. We're about 30 basis points down from the peak in the 10-year yield. We're just around 407 at the moment on your 10-year. And Kelsey, amid that, Barclays is writing that rally has just gone too far. We are near the lower end of what you think the range should be at the moment. Has the rally gone too far in this bond market?
So we do think that we're in a range environment for the 10-year Treasury yields right now. So the lower end of the range is around 4 to 4.1%. We're essentially there now. And as you mentioned, yields have recovered fairly substantially from the upside surprises of January. So the market is, in a sense, already anticipating this reversion to the mean, that January was the outlier. And now things are going to start looking more normal in the upcoming data. So the market is somewhat priced for that. On the other side, the 100-day moving average on the 10-year yield is around 4.3%. And that's been a fairly good support level for the market. It's been tested a number of times in February. So that's the range that I would be watching, particularly as we head into CPI tomorrow.
Jason, what do you make of that? 4.3%, probably the area you want to buy if that's around the top. Does that make sense for you?
Yeah, I think I'd say our range is like 3.8 to 4.3. I think if you get over 4.3 up to 4.5, I think you get a lot of investors who are you're looking to buy duration, would want to kind of step in. Maybe they missed the opportunity last October when the 10-year got to 5%, thinking it would go higher, and then very quickly it reversed. So unless you really believe the Fed is not only going to not hike or not cut rates at all this year, but even well into next year, there's a bit of a ceiling of how far the 10-year is going to go, because at that point in time, you have to think the Fed will cut. If I can lock in a 10-year at 4.5% versus having to worry about the reinvestment risk as the 10-year or as the front end of the curve falls, I think you get sort of a pretty strong bid. So 4.3, but definitely 4.5, I think will be the point where I think a lot of investors want to step in and add duration at that point in time.
Well, there are certainly an opportunity to buy a lot of duration this week. We have a lot of auctions, $56 billion of 3-year notes today, $39 billion 10-year tomorrow, $22 billion of 30 years auctioned on Wednesday. Kelsey, this had been a fear of the market in 2023, but is that just so 2023? This in March of 24, are we no longer worried about bond market supply?
So bond market supply is an important technical, particularly, when you're looking in the very short term. So I would expect to see some movement in prices around the auction, but this week is obviously very important, and it's important for fundamental reasons. And I think those fundamental reasons are ultimately going to be driving markets. CPI is one thing, but we also have retail sales and PPI. And the reason I highlight those is those are the last real pieces of information that the Fed is going to get before their March meeting. PPI plus CPI is what gives the Fed the ability to project PCE, which is their official preferred measure of inflation. So you have CPI, that's going to move markets, but you may need to hold your breath a little until we get to PPI to really get a sense of what the Fed's preferred measure is going to look like for February.
Yeah, I mean, it is a crazy and busy week, and because of that, we should get to what we expect for the numbers themselves. Let's bring in Bloomberg's Michael McKee, who joins us now with a preview for all those numbers. Mike.
Well, it is a busy week, but it's not as bad as last week because, well, let's start with the Fed calendar. Nothing. We're in the blackout period. So this is your week ahead for the Fed watchers. You don't have to do anything. You have to watch the data because, as Kelsey was just saying, we get not only CPI, but we get PPI this week. You put those two together and you get a pretty good idea of what the PCE is going to be. We also get retail sales, jobless claims, and Michigan sentiment, and all this folds together because the Fed wants to know if it's interest rate level is restrictive or not, and if the economy is slowing or if it is picking up speed. We should have a pretty good idea by the end of the week where we are. Now you go to the CPI, and that's going to be the number of the week because inflation is front of mind for everybody at the Fed. It's going to be interesting because we're going to see probably, according to economists surveyed by Bloomberg, a higher month-over-month level that will result in a lower year-over-year level because of base effects. You can see this here where you have a big increase in inflation last year, which makes it harder to go up as much this year. So we should see a decline in CPI on a year-over-year basis to 3.1% on a headline, but 3.7% on the core. That would be progress continued. And of course, we are, Dani, not talking about the March Fed meeting except for what they project going forward. We're talking about in context of the markets, whether this CPI report and this week's data will give us any conviction about May or June for a rate cut.
That's all we want is conviction, Mike. That graphic about Fed speak needs to go into the Hall of Fame. That is the best thing I've ever seen. That was not a mistake. There's no one talking this week. Mike, thank you so much. Bloomberg's Michael McKee. Now, speaking of trying to get conviction in this market, the one place we had it and maybe lost it was Nvidia. Let's look at the market, those shares pre-market. They are down 0.5%, but that's nothing compared to what we saw on Friday. It was a swing of $250 billion wiped out in the span of 3 hours. Unclear if that's ever happened for a single stock in this market before. It was up 5%, down 6.5%, ended the day down 5.5%. And here we are at the moment, $171. But JPMorgan's Mislav Matecho writing and pushing back against the big tech valuation concerns. He says there's a concern over the very strong outperformance of the Magnificent Seven, but we note that the group is currently trading less stretched than a few years ago, given earnings delivery. Kelsey Berro and Jason Draho are still with us. Jason, can you put aside the volatility, the peak tech concerns, because earnings are still okay?
Well, I would agree with the statement that the valuations for a lot of these tech companies is actually reasonable when you factor in just how much the earnings have grown over the past few years, and also the expectations we have for growth, particularly in the AI space. The amount of spending we're seeing is sort of ramping up faster than anticipated, even 3-6 months ago. So when I think about the markets overall, I mean, there is two main drivers right now. There is the macro story where people are sort of still embracing the soft landing, and then we have this sort of more micro idiosyncratic story, which is the AI story, and the real kind of beneficiaries there. So when I look kind of the combination, that both those effectively are a bit of tailwinds for the market. You can look at the micro AI story. I think this is going to drive things, these pockets of the market higher. And if the macro plays out as we anticipate, that's also another tailwind. So I kind of think of it as both sides of the same coin, that for the equity markets overall, we can kind of look through some of this volatility thing, and there's two relatively strong tailwinds. Not necessarily a huge upside this year, but definitely kind of tailwinds to support equities at these relative levels.
I mean, I've heard it said that what happens to Nvidia is a macro story, that it could be a macro event that unleashes volatility should something go wrong, for example, in future AI conferences that they're leading and hosting. Kelsey, how transfixed is the bond desk by Nvidia? Is it a part of the conversation there?
Well, it's absolutely part of the conversation, but I would say more broadly, this is a debate about valuations and about fundamentals, right? About earnings power. So when we look at the corporate fundamentals in the investment grade and high yield credit markets, we see fundamentals that are still very strong and very supported. So, the question that we've been grappling with, in the equity markets, it's about PE multiples. In the bond markets, it's about how tight credit spreads are. And if those credit spreads are justified by the fundamentals, credit spreads are narrower than they've been in a long time, but we do think that the corporate fundamentals do justify those spreads. And then if you add on top of it the technicals, the demand for fixed income that we've been seeing, particularly corporate credit, it still looks like a very good environment for credit here, both investment grade and high yield.
Yeah, that demand for credit has been insatiable. Kelsey, Jason, stick with us. Much more to discuss. But first, now let's take a look at some of the stocks that are on the move ahead of the opening bell. With that is Abigail Doolittle. Hey, Abby.
Well, Dani, we do, of course, have futures down. But before taking a look at the stocks that are dragging, let's take a look at one stock that's popping. And not surprisingly, it has to do with Bitcoin's climb to 71,000 and then 72,000. That is, of course, MicroStrategy, the software company, but also trades Bitcoin, sort of a principal trader, up 9%. This after gaining 100% in the month of February. So folks still want in. Boeing, on the other hand, down 2.2%. Of course, there was in-air turbulence on a LATAM flight from Sydney to Auckland. A 787-9. 50 people were injured, 10 people hospitalized. This adds to a number of the disturbing incidents that have occurred on these planes after the tragedies in 2018 and 2019. Secretary of Transportation Pete Buttigieg saying the company is going to face enormous quote-unquote scrutiny. And then finally, Meta down 1.8%. I'm not exactly sure what's behind this, Dani, but it is certainly a big drag. Some of the other Mag 7, they are higher this morning. There is, of course, that bill to ban TikTok here in the U.S. Some are saying that could be a positive for Facebook, but after its nearly 500% run out of the October 2022 lows, maybe something that, stock needs to cool off, or maybe that there could be some sort of regulation for Meta.
Yeah, maybe it's just the lull between payrolls and CPI, and why not take profit in that window? Abigail, thank you very much. Coming up on the show, the Bank of Japan shifting its strategy.
They're definitely collecting all the intel from Japanese companies and seeing upside surprises to internal company wage settlements. And they know they need to act. They need to flip expectations at the very least.
We take a look at the next steps for the BOJ. Up next, this is Bloomberg.
March is certainly a live meeting, and I think they're looking at the GDP data, and also they are looking at the underlying data in terms of wages. We know it's been the spring wage round, and they're definitely collecting all the intel from Japanese companies and seeing upside surprises to internal company wage settlements, and they know they need to act. They need to flip expectations at the very least.
The Bank of Japan is steering clear of ETFs for the first time since 2021. Usually they buy the dip when it falls 2%. But not so this time. Now, they, of course, have their meeting next week, and all of this is feeding into speculation of an imminent policy change. Joining us for more on this is Bloomberg's Ven Ram. Ven, does this mean that they're getting ready to normalize policy if they didn't buy the ETF dip? Or is it just the BOJ saying, we're at records here? Why do we need to buy?
Morning, Dani. I think it's more of the former. I think that the BOJ is sending out an unequivocal message to the markets that, look, we are preparing to exit negative rates. And what they did with the ETFs today, or what they did not do with the ETFs today, is the message that is congruent with the fact that they are going to exit negative rates. The BOJ is also said to be considering scrapping its curve control in favor of a plan where it indicates in advance the amount of bonds it plans to purchase. Essentially, those two moves are telling the investors out there that the bank seems to be willing to move away from rigid curve control, where it is more willing to let the markets determine where bonds should be trading, where stocks should be trading. So that is consistent with what you would expect when the central bank is about to exit negative rates.
And there's a lot of speculation that's going to happen. It's really kicked off this month in March. But even so, the yen is only strengthened about 2% versus the dollar, Ven. That does seem quite reserved when you think about what happened in 2023 on Kuroda's way out, where we got a strengthening of something like 5%. What do you make of that?
Absolutely, Dani. I think that the markets are in a case of once bitten, twice shy. Because, as you said, it's happened many times before where the markets have been wrong-footed by the BOJ. And this time around, the markets are being cautious about how much they are putting up on the yen. And I think that, the yen has rallied only 2% so far this month. So if anything, if the BOJ disappoints next week, the case for a sell-off is not so good because it doesn't run up so much. So I think that is a positive message. If the BOJ starts exiting negative rates and starts raising rates further down, the markets are thinking 25 basis points by the end of the year. And if you've got a situation where the Fed is also going to cut rates, probably in the second half, I think that the yen is in for good appreciation later this year.
Long live the Widowmaker trade. Ven, thank you very much. Bloomberg's Ven Ram. Kelsey Berro and Jason Draho are back with us. Kelsey, is this now the window of opportunity for the BOJ to act? Are you expecting some normalization this month?
So you described it correctly in terms of having a window for opportunity, because we do expect that it is going to be a more challenging story for the Fed, for the BOJ to be normalizing if the Fed is cutting rates, which we expect them to be cutting rates by June. So the BOJ right now does have an opportunity. We do think that they're going to take it. It's a little tough to call exactly when, if it's this meeting or next meeting. But what we do expect is that they're going to exit negative interest rate policy. And eventually, they're also going to get rid of that yield curve control policy as well.
And that was enough to send equities in Japan down more than 2%. As we were talking about with Ven, usually the BOJ would step in at this point and buy ETFs. That has long been their policy. But Jason, Japanese equities have been on quite the ride, setting new records, touching 40,000. Is the narrative, is the attractiveness of Japanese equities dented if this is a BOJ set on normalizing policy?
I don't think that's the case, largely because ultimately what's attracting investors to Japan equities is, I think, two main factors. One is there's a positive sort of structural story that you're seeing play out with among Japanese corporates, whether it is thinking about governance reform that is more shareholder friendly, increasing payouts, ultimately kind of focusing more on return of capital and higher return on investment. So I think it's a structural story that's been playing out for a number of years, and that will continue to play out. So that's one thing that's attracting investors. The second thing is just I think globally investors are underallocated to Japanese equities. I mean, they're basically overallocated to U.S. equities and underallocated to everything else, Japan being one of them. And as we see the story of Japan not just being a sort of very short-term cyclical trade that's tied to the BOJ, but there's a structural story. I think you're seeing more and more capital moving in that direction. I think there's legs for this to play out over time. I think given the structural story and drawing capital, it's not just purely a play on what the BOJ might do. And if they don't deliver as much or they even deliver a little bit more than expected in the market, that won't really alter the fundamental trajectory for Japanese equities.
I mean, Warren Buffett's already in that pool. You're surprised more people haven't moved over by this point, given that. But Kelsey, a similar story has long been said about this bond market. Again, the fear was more alive in 2023 when Kuroda left and brought up the possibility, or did indeed tweak yield curve control, that it would lead this exodus of Japanese investors in American markets and bring that flow back home. Is the bond flow challenging? Is it more challenged if we get some of that this year? Or is that narrative less of a factor if we're getting a Fed that is on its way to cut?
Dani, that's a really great question, because that's exactly the line of thinking that clients ask us. They say, okay, so in a vacuum, maybe not that important that the BOJ is increasing rates by 10 basis points. They went from negative to zero, big deal. But as we know, the Japanese flow in the global fixed income market is extremely important. And so what we've done is we've looked back historically about what drives fixed income flows from Japanese investors into the U.S. bond market. And what we've actually discovered is ultimately the bigger driver of flows, it comes from the monetary impulse in the U.S. So essentially, you saw the biggest selling from Japanese investors of U.S. bonds in 2022. That tapered off in 2023. And we're already seeing on net buying of U.S. fixed income this year. And it's not because the market or Japanese investors don't expect the BOJ to act, but it's more of anticipation that the more important element is the Fed normalizing policy and cutting rates later this year.
Fair enough. We're almost out of time, but Jason, I got to squeeze this in because part of the difficulties of China's market has also been made clear by the attractiveness of Japan. China's underperformed EM. The globalization story is challenged. The data is challenged in China despite the support. Can you still buy Chinese equities at this moment in time?
Well, ultimately, we think there's an allocation for Chinese equities in a portfolio. Just think about it. It's still a sizable percentage of emerging market equities. It's close to a third. So you don't want to ignore it entirely. I guess the question more is, do you believe this is an opportunity to be tactical and really kind of allocate it to it? I think there we're a little bit more cautious. Given sort of the fits and starts in policy, I think investors are a little bit skeptical. So we would sort of have some allocation, but not be looking to be tactically overweight to the Chinese equities at this point in time.
Kelsey, Jason, really appreciate your time this morning, setting us up for a potentially challenging week. Kelsey Berro of JPMorgan and Jason Draho of UBS. This is Bloomberg. Let's get your morning calls on this Monday. A look at some of the analyst recommendations on Wall Street. First up, Morgan Stanley downgrades Hyatt Hotels to equal weight. They say there's a more balanced risk reward following recent gains. Next up, Truist upgrading Procter & Gamble to buy, pointing to strengthening volumes and encouraging China commentary. Finally, Oppenheimer, they have raised its Netflix price target to $7.25, citing the company's ability to grow its long-term subscriber base. Seconds away from the opening bell, stocks are on the back foot this morning. We're looking at NASDAQ underperforming, down 0.4%. It is this strange period in between another big data release. So maybe now is the time to take profit on this equity market, especially the time where on Friday, Nvidia losing $250 billion of market cap in the span of 3 hours. Elsewhere, your other markets, they are hanging tight. Bond markets, little change this morning. Again, maybe it is the holding period ahead of a CPI. We're also living in fear of last month's CPI, where it was a hot enough number to cause a rupture in bond markets. Kelsey Berro of JPMorgan says they are focusing on the longer-term trend that the data is normalizing. NYMEX crude falls 0.7%. Your euro versus the dollar at 109. 10-year yields at 407. Now, one stock to watch at the open this morning. It is Boeing shares. They're moving lower. It was a weekend of negative headlines. That included the DOJ opening a criminal investigation related to its fuselage incident back in January. Bloomberg's Katie Greifeld joins us now for more. Katie, the negative news flow does not seem to be letting up.
Not for Boeing. Yeah, more bad news for Boeing, which is also bad news for Delta, interestingly enough. Remember that Delta has orders for 100 MAX 10 planes and options to purchase 30 more beyond that. But we had been expecting to begin receiving those planes for Delta next year. But we heard from CEO Ed Bastian saying that his guess that the delivery date would be delayed by a year or two beyond that, which gets us to 2027. Now, of course, Bastian's comments come as Boeing undergoes both federal safety and criminal reviews after a series of incidents. And as a result, federal certification of the MAX 7 and the MAX 10 models, that's been delayed. And of course, we also heard from U.S. Transportation Secretary Pete Buttigieg, who said that Boeing faces enormous scrutiny from the regulators right now. You can see that's pressuring Boeing shares. They're currently off about 2%. They're down about 24% for the year, Dani, one of the worst performers in the S&P 500 so far in 2024.
Ouch. Katie, thank you very much. Bloomberg's Katie Greifeld. From the aviation world to the banking world, it's been exactly 1 year since the collapse of SVB. Can you believe it? It's been 1 year. And the concerns, they are still with us. JPMorgan sees a murky path ahead for New York Community Bank. Joining us for more is Bloomberg's Abigail Doolittle. Abby.
It is hard, truly hard to believe that it has been 1 year since the blow up of Silicon Valley Bank and all of the gyrations that it brought to the financial markets, including a big bid for treasuries as yields sunk, stock selling off briefly. The other regional banks selling off in sympathy by amounts greater than 50, 60, 70%. But one stock that held up until this year, Dani, was New York Community Bank Corp. It was actually up more than 20% for most of the period of time after the SVB blow up. But then, of course, they reported that quarter not so long ago where there's concerns around their great concentration to commercial real estate loans. Lots of different factors there, including cutting the dividend, being cut to junk. And all of this did lead Steve Mnuchin to lead a $1 billion rescue that we heard about last week. But they do, of course, as you were mentioning, have their work cut out for themselves going forward under the new management to cut the CRE exposure, that commercial real estate exposure, and also to build deposits and good assets, decide whether they want to stay above the $100 billion mark for more regulation or come back in. And as you mentioned, JPMorgan saying that it's a murky path ahead, but at least there's a path.
That is the good news. Abby, thank you very much. Man, the bar feels so low these days. Bloomberg's Abigail Doolittle. All right, let's get you some good news. Let's turn to crypto. Bitcoin surging above $72,000 at one point. It's providing another boost for crypto-related stocks, and it sent Coinbase to its highest level since 2021. Let's bring in Bloomberg technology co-host Ed Ludlow. Ed, what you got for us?
Yeah, there's obviously a high degree of correlation between the upward move in Bitcoin and crypto-related or crypto-adjacent stocks. Coinbase up 3% in the session, as you said, highest level since 2021. It also takes its year-to-date gain above 50%. I would also point out that this kind of move is not uniform, right? We don't see all crypto-related stocks having the same level of year-to-date gains. There are many that are declined, whether they are crypto trading platforms or blockchain adjacent companies. For example, Riot Platforms is down 18% so far year to date. MicroStrategy, a name I know you guys discuss a lot, is up more than 139% year to date. And that's basically a Bitcoin exposure play. So the broad consensus reading across the Bloomberg terminal this morning is about accessibility, that we look at Bitcoin 71,000 and we say, okay, with the advent of Bitcoin spot ETF, the news coming out of London about the access to crypto products, that looks good. The other thing I'm watching this morning is Reddit finally launching its IPO more than 2.5 years after filing confidentially. 22 million shares for sale at a range of $31 to $34 a share. At the upper end of that range, it would give, on the shares outstanding, a valuation of $5.4 billion. On a diluted basis, $6.4 billion. And what's interesting about Reddit's IPO, 8% of the shares on offer will go to Redditors or friends and family of Redditors and Reddit-related people. And there's no lockup on that 8% of the shares, which I find really interesting. But this is kind of a big one in my world, right? This is the tech IPO we've waited quite a long time for. And if it happens, it may be kind of a starter gun for some other tech names waiting in the wings.
And everywhere, IPO bankers are sighing a breath of relief if it is coming back. Right. Ed, thank you so much. Bloomberg's Ed Ludlow. Now, another stock we are keeping our eye on is Nvidia. After last week, two directors sold about $180 million of shares in the chip maker, cashing in on a record run, and then volatility on Friday, wiping out $250 billion in the span of 3 hours. Joining us for more on this is Bloomberg's Isabel Lee. Hey, Isabel.
Hey, Dani, we may see a little bit of a dip today. Nvidia is now down around 2.5%, but that may be just nothing compared to the 70% year-to-date gain, almost 260% in the past 12 months and 550% in the past 3 years. So we have two directors cashing in on that gains. We have Tench Cox. He's been on Nvidia's board since 1993, and he sold around 200,000 shares on March 5. That amounts to around $170 million. And he still has around 3.7 million shares. Then we have Mark Stevens. He's been a director since 2008, and he sold around 12,000 shares. So that amounts to around $10 million. So this sale comes after this blistering rally we've seen in Nvidia over really just optimism that the demand for this AI chips will remain unabated. And Nvidia now posts a market cap of around $2.2 trillion. So it's just behind Microsoft and Apple in the S&P 500. And last month, we also had directors unloading around 99,000 shares. And that's around when Nvidia reported its blowout earnings. So they unloaded around 80 million at that time. So you know how last year we began with Magnificent 7? In my inbox this year, we're seeing some notes saying it may be just Magnificent 1. Because, for instance, Nvidia is hitting record after record, but Apple, for instance, is hitting a technical correction. And yes, some in the Magnificent 7 may have been seeing gains like Meta, Microsoft, and Amazon, but it's really nothing compared to Nvidia's gain, Dani.
Yeah, I think we're just going to have to drop the Magnificent moniker at this point rather than trying to force it to work with a Magnificent 1. Bloomberg's Isabel Lee. By the way, with that 2% decline nearly in Nvidia this morning, added to the 5.5 on Friday, and it's the biggest two-day decline for Nvidia since October 2023. All right, let's widen out the conversation. Tony DeSpirito, BlackRock Global CIO of Fundamental Equities, says that while fixed income may be the most attractive it's been in quite some time, we still see equities as the best asset. Joining us now is the man himself. Tony, of course you have to say this. You're CEO of Fundamental Equities. I know we're going to get some angry emails from bond investors very shortly, but tell me why. Why do equities still reign supreme in 2024?
Yeah, thank you. I think it's a matter of history. Look, if you look over the long run, equity returns have been higher than bond returns, and that compounds over time, and that compounding is really important to investors. So I just want to make sure the message is out there that yes, bonds are, like I said, the best they've been in a long time, but don't forget about equities, because equity returns are what's going to form the ballast in the portfolio, and that's what's really going to drive capital appreciation for clients over the long run.
But I look at the calls that started this year. I did a little trip down memory lane of January 2024. Goldman called it the year of the bond. Bank of America says they'd rally big in 2024. PIMCO called it prime time for bonds. I mean, were they wrong? Did we sort of over-egg the ability of the bond market to rally this year?
Well, I think if you look at the returns of stocks year to date, it tells the story, which is the story of the long run. On average, stocks outperform bonds. And that's true whether you look at a 1-year period or a 10-year period. Of course, the odds of stocks outperforming, the longer your time horizon, the higher those odds are.
Tony, does concentration risk scare you at all when, again, on a day like Friday? I've said this stat a lot over the past 40 minutes because it is remarkable that Nvidia can swing in one day to the degree of $250 billion. That's got to be some sort of record. Does that sort of thing not give you pause about the direction of this equity market with so much hanging on so few stocks?
Well, certainly the indices have become more concentrated. That is true. But I think, as a stock picker, I don't just look at the cap-weighted S&P 500. I also look at the equal-weighted index, the equal-weighted S&P 500. And that tells a very interesting and different story. Historically, those valuations have been about in line. Right now, the equally weighted S&P 500 trades at about a 23% discount to the overall S&P 500. So I think that's really interesting. You're starting to see the market broaden out some this year. More recently, you see financials doing well, you see parts of industrials, et cetera. So I don't think it's just about the Magnificent 7, particularly if you're a stock picker. I think there are ways to find exposure to some of the hottest themes, like artificial intelligence and other innovative themes, through other smaller, mid-cap, even large-cap stocks, just not even mega-cap stocks.
Where's that AI theme not played out to the extent it should be? Because there was a moment in time, maybe not as much anymore, but all an executive had to do was mention AI on an earnings call and their stock would rally. Where are we underappreciating the AI narrative?
Yeah, so we really think about it in terms of a tech stack, and right now the hottest area is that bottom layer of the stack, the chip and hardware layer. And that's where a lot of the attention is being placed right now. But as we look forward, I think what you're going to see is companies differentiate themselves in how they use artificial intelligence. So one area that we've been looking really hard at and investing in broadly is companies that own and sell data. They make good money off of that today, but if you think about an AI world just makes that data more valuable and will allow them to price that data even higher. And so I think that's a real area of profitability. We're also going to see companies cost cut using AI. Certainly, we're seeing it right now in terms of coding. We're seeing that AI add a lot of productivity to coders. We're going to see it in call centers. And so I think we're going to see the use of AI broaden out. And maybe you're starting to see that in the productivity numbers. If you looked at fourth quarter productivity numbers, they were quite good. And so that's what I would expect as time plays out.
This idea of what AI does to productivity is a fascinating one because many folks, even like yourself, Tony, say that we are currently in the late cycle. But will this cycle look the same as past ones? Again, if there's this underlying upcurrent of productivity boost from AI.
So I think artificial intelligence is really going to be critical to see whether we're late cycle or not. So certainly when you think about typical late cycle indicators, unemployment below 4%, I would put that in the late cycle, interest rates high, inverted yield curve, et cetera. So there's a number of things indicating we're late in the economic cycle. On the other hand, if AI can continue to boost productivity, we may stay in this Goldilocks environment where the economy can continue to grow without overheating. And so that's certainly part of the bull case going forward for equities.
Can the bull case sustain itself without that, Tony?
No, I definitely think we need productivity growth. So far, we've been getting it. We need that to continue. At the same time, as a stock picker, I think you can also provide some protection within your portfolio. When I look at defensives broadly, whether that's healthcare, staples, or utilities, these sectors, historically are great defensive sectors in a late cycle economy, yet today they're all trading at discount. So I think adding some of those companies to your portfolio as a defensive way of hedging yourself is also really smart at this point in the cycle.
Yeah, as you write, Tony, it's a new era, alpha over beta. We'll see how that plays out. Come join us again, Tony DeSpirito of BlackRock. Thanks for your time this morning. Coming up on the show, Biden calls for restraint in Gaza.
The defense of Israel is still critical, so there's no red line, I'm going to cut off all weapons. But there's red lines that if it crosses, and you cannot have 30,000 more Palestinians dead.
We're going to have more on the president's warning to Israel. That's up next. This is Bloomberg.
The defense of Israel is still critical, so there's no red line, I'm going to cut off all weapons so they don't have the Iron Dome to protect them. They don't have. But there's red lines that if it crosses, and you cannot have 30,000 more Palestinians dead as a consequence of going after. There's other ways to deal with the trauma caused by Hamas.
President Biden there warning Israel against an attack on the Gaza city of Rafah. Ceasefire talks, with Hamas remain deadlocked as Muslims enter the holy month of Ramadan. Bloomberg's Anne-Marie Horder joins us now with the latest. Anne-Marie, this is the point at which the Biden administration had hoped that there would be a breakthrough before Ramadan, but we are still not there yet.
Yeah, the Biden administration, President Biden himself was in New York when he made those comments, talking about the fact that he was hopeful for a ceasefire to happen past Monday, so 7 days later, and we're already into the holy month of Ramadan. President Biden over the weekend talking about this, and we had Aaron David Miller on from the Carnegie Endowment International Institute of Peace in surveillance, and he talked about this being a pink line, because President Biden is walking a fine line. He said two things. He said there is a red line, but I'm never going to leave Israel. And then he said, but there is a red line when it comes to we cannot have 30,000 more Palestinians dead. There's other cases to get to deal with trauma caused by Hamas. So you could see a growing distance between President Biden and the Israeli government. Something the president brought up in the State of the Union, though, is that he wants to continue fulfillment in terms of humanitarian aid to Gaza. So the U.S. will be embarking on creating this pier off the Gaza Strip. The issue is, though, it doesn't look like the president's remarks mean that Netanyahu is not going to go into Rafah, which the president was trying to say that is a red line, even though it's not a red line to continue supporting Israel.
And Maria, elsewhere in Washington on Wednesday, we're going to get this vote on banning TikTok. Does it look likely to pass?
Well, look, if this vote goes to the floor in the House, we also talked to Henrietta Trace this morning, who's tracking this, and said if it goes to the House floor vote on Wednesday, likely we could see this pass. It needs to pass with 2/3 of vote the way this is going to be introduced. Then it goes to the Senate. And we heard from both Senator Warner and Senator Rubio over the weekend on Face the Nation. And the direction of travel does look like they want to see a bill, legislation similar to this. How the Senate maneuvers around this, we'll have to wait and see. When does Schumer put it on the floor? But President Biden said if Congress passes this, he will sign it. A little hypocrisy there, Danny, given the fact that the Biden campaign is at this moment campaigning on TikTok to try to reach the youth. And then also you have to throw in this potential spanner in the works with the former President Donald Trump throwing cold water on whether or not TikTok should be banned. This was something he talked about when he was in office, actually had an executive order about it that went into the courts. But now he's saying, nah, I don't want to ban it because it may help Facebook. Others are pointing to the fact that there's a lot of high net worth donors he's after who have serious stakes in TikTok.
Yeah, fair enough. I got to say, I've seen a huge uptick in commercials from TikTok basically saying, look how wonderful we are. Look at the great messages we're spreading.
Well, TikTok did tell their influencers to call members of Congress so they do not support this, but it backfired because it sailed through that committee 50-0 in terms of the vote count.
Yep, a defiant Congress. Anne-Marie, thank you very much. That is Bloomberg's Anne-Marie Horderin. Okay, let's get to some of the sector price action this morning. With that is Bloomberg's Abigail Doolittle. Hey, Abby.
Hey, Danny. Well, overall, we are looking at a small decline for the S&P 500, down about 0.3%. It's a broad-based decline, but the declines are not too severe. We don't have any sector down more than 0.7%. Industrials, the worst right now, down about that amount, being dragged on, not surprisingly, by Boeing and any fallout. Energy down the next most, down about 0.5%. This as oil is declining by about 1%. To the upside, materials and consumer staples up 0.3%, respectively. So again, not a lot of drama here, as John used to like to say, quite a bit relative to the tech index, though, because we're not seeing it there with the declines for those mega cap tech indexes. Take a look at the NYSE FANG Plus index over the last 2 days, down 2.7%. And the real head scratcher here is the one I was mentioning before, Danny, Meta. It's now down 4.1%. Its worst day since October of last year. There's no news that really seems as though would be dragging on it, except that we do, of course, have that TikTok bill that could potentially be passed. President Trump, not so long ago, former President Trump, I should say, saying that would be a positive, but it seems maybe some investors disagree with that stock really dragging on that index overall, down about 4.2%. Most of the stocks in that index down, but not to the same degree.
Abby, thank you very much. Abigail Doolittle there. Now, one thing that seems to be holding up that's maybe more risky is Bitcoin. It is still up about 3% at one point, touching $72,000. This rally continues to build steam. The ETFs, maybe you're getting a wider audience pouring into this. I was talking to Amy Wu Silverman of RBC last week, who said that this rally, it's what's igniting some of the more speculative behavior in the stock market. Because if you are an investor in Bitcoin, you all of a sudden have more gains. Perhaps you take some of that and put it into call options in tech. So Bitcoin still on the way up, still up 2.8% this morning, pulling back from that 72,000 level. All right, coming up, we're going to take a look at some of the market moving events that you need to be watching throughout your week. That is next in our trading diary. This is Bloomberg. About 30 minutes into your trading day so far. A weaker day, but nothing horrific. We are down more than 0.5% for most of these indices, but your S&P down about 0.4%. We are looking at a NASDAQ that's down 0.6%. There had been some selling, some heavy selling of Nvidia on Friday. The big cap tech also struggling this morning. Perhaps it has to do with CPI tomorrow. The expectation 0.3% month over month. 0.4 rather. It was 0.3 last month, but we realized last month of what happens when it comes in hotter than expected. It is a market that gets disrupted. We have a lot of data on deck. will that disrupt the rally that we've seen year to date? Speaking of which, let's get your trading diary of what you need to be watching this week. Biden proposes the U.S. budget to Congress today. The numbers for February CPI, as I said, those come out at 8:30 a.m. on Tuesday. VW, Adidas both report earnings on Wednesday, and then we get more data. U.S. PPI, retail sales, another round of jobless claims come out Thursday. And then if that's not enough, we round out the week with UMich consumer sentiment out next Friday. So take this Monday as a break, as a relief before the big data releases.